Welcome, and thank you for participating in the Wisconsin Credit Union League's training on Bank Secrecy Act and OFAC compliance. My name is Paul Gatormson, and I'm the VP of Legal and Compliance for the League. These webinars are designed to give credit union staff an understanding of what federal regulators require credit unions to do in order to comply with the Bank Secrecy Act and with Office of Foreign Assets Control, or OFAC, rules. The League offers a separate and shorter webinar for credit union boards of directors, giving them a high-level overview. We've divided this material into 3 parts. This is a roadmap of the topics that the webinar series is designed to cover. This webinar is part 1, which is highlighted in red. It starts with some background. What's the purpose of BSA, and which government agencies monitor for BSA compliance? We'll talk about the need for each credit union to have a BSA risk assessment and a written BSA policy that's based on that assessment. And then we'll go over the 5 basic requirements that your policy must address, like having a BSA compliance officer, having regular staff training, having a customer due diligence program, and so on. Let's start by looking at BSA, what it is, where it came from, and what it's designed to do. The Bank Secrecy Act is a series of federal laws designed to help the government and law enforcement detect and prevent money laundering. It's often referred to together as BSA/AML to reinforce the anti-money laundering aspect. The BSA laws help identify the source, volume, and movement of currency and other monetary instruments that are transported or transmitted into or out of the U.S. or move through financial institutions. In addition to preventing money laundering, it helps in the investigation of tax evasion, international terrorism, and other criminal activity. Those of you who are new to credit unions might be unfamiliar with the Bank Secrecy Act. It's actually been around since 1970. And here's a timeline of the different laws that come into play when we're talking about BSA. In 1970, Congress first passed the Currency and Foreign Transactions Reporting Act, which is commonly known as the Bank Secrecy Act. It established requirements for record keeping and reporting, such as for large currency transactions. Those types of records are important because they help law enforcement and regulatory agencies pursue criminal, tax, and regulatory investigations. Then, during the 1980s and 90s, the Act was amended and enhanced several times to give law enforcement more tools to fight white-collar crime, tax evasion, money laundering, and terrorism. In response to the terrorist attacks of 9/11, Congress passed the USA Patriot Act, which is the single most significant anti-money laundering law that Congress has enacted since the BSA law itself. It enhanced the BSA framework by strengthening customer identification procedures, requiring due diligence, and in some cases enhanced due diligence procedures, and improving information sharing between law enforcement agencies and financial institutions. The Bank Secrecy Act itself is a series of federal statutes enacted by Congress and found in the U.S. Code. In the BSA, Congress instructed federal agencies to enact regulations that detail exactly what different industries must do to comply with BSA. A department in the U.S. Treasury called FinCEN, the Financial Crimes Enforcement Network, has comprehensive BSA regulations for all financial institutions and other industries. Another group that you'll hear me refer to is the Federal Financial Institutions Examination Council, or FFIEC. It's a group that includes all of the federal regulators of financial institutions. The NCOA, National Credit Union Administration, is a part of the FFIEC, along with some other banking regulators, the Federal Reserve System, the Federal Deposit Insurance Corporation, or FDIC, the Office of the Comptroller of Currency, or OCC, and the Consumer Financial Protection Bureau, or CFPB. Together, they publish a manual for use by all examiners who monitor BSA compliance to ensure consistency in how the rules are enforced. The FFIEC's BSA exam manual is a great resource, with overviews of all the various requirements, and it explains the exam procedures so you know exactly what examiners will be looking for. It's really the Bible for BSA compliance. The NCOA, along with Wisconsin Office of Credit Unions state examiners, monitor Wisconsin credit unions for BSA compliance. Other federal banking regulators, like the FDIC, oversee compliance for other institutions, like banks. Part 748 of the NCOA regulations requires all credit unions in the United States to have a written BSA program and procedures that are designed to ensure BSA compliance. Let's talk about what that written BSA program needs to include. Basically, there are two parts, a risk assessment and a policy. All of your credit unions should have a BSA policy in place already, but the question is whether it's adequate and tailored to your operations and risks. BSA compliance is risk-based. In other words, you can't simply adopt a form policy for BSA compliance. One size does not fit all. The first step in BSA compliance is that the credit union should look at the risks it actually faces and then put together a BSA program that tries to mitigate those risks. You should have both a broad policy that sets your goals for BSA compliance and written procedures which spell out exactly what staff should do to keep the credit union in compliance. For example, if they think a transaction is suspicious and it may need to be reported to authorities, your procedures should let staff know what to do. And of course, your staff has to know what your policies and procedures require and follow them. The first step in having an effective, compliant BSA program is to complete a risk assessment. The credit union should take into consideration the products and services it offers, the field of membership it serves, and its geographic locations. Once you've looked at the risks, you can make decisions about what procedures your credit union needs. We have a basic risk assessment matrix attached to the League's II release number 0071. By the way, the League's II, or Important Information releases, are written by the Legal Affairs Department to help explain various legal issues that affect credit unions. The releases are available to all staff, management, and credit union volunteers at our website, www.theleague.coop. The risk assessment matrix will help you consider all the factors that might affect the risk of the credit union being used for criminal activity, terrorist financing, BSA violations, and so on. Just filling in the blanks of that matrix isn't really enough, though. Your credit union's management should brainstorm and determine what areas put your credit union at risk. The more detailed the analysis, the better, and the more the examiners will trust it. You should update that risk assessment every 12 to 18 months, or sooner if key elements in your risk profile change. A thorough risk assessment is fact-specific. In other words, it must take into account each credit union's unique circumstances. The credit union should consider all of its business lines in the risk assessment. Step 1 in the risk assessment process is to identify the specific risk categories that apply to your credit union. The exam manual provides guidance on 3. Number 1, higher risk products and services. Number 2, higher risk customers and entities. And number 3, higher risk geographic locations. We'll take a look at each of these 3 categories in the next few slides. The FFIEC's BSA exam manual lists products and services that may pose a higher risk of money laundering or terrorist financing, depending on the nature of the specific product or service offered. The list is on the screen, and we've added one. The NCOA has said that credit unions should consider shared service centers in their risk assessments because they're unique to the credit union movement. There's some others I want to point out. Electronic funds payment services means things like prepaid and payroll cards, funds transfers, either domestic or international, third-party payment processors, remittance activity, automated clearinghouse or ACH transactions, and automated teller machines or ATMs. The term monetary instruments includes official credit union checks, cashier's checks, money orders, and traveler's checks. Concentration accounts are internal accounts established to facilitate the processing of transactions on behalf of multiple or individual customers. For example, concentration accounts are sometimes used for funds transfers. They're riskier for money laundering if the customer identifying information is separated from the transaction. So, the USA Patriot Act emphasized the need to monitor activity that occurs through such accounts. Certain lending activities can be higher risk, particularly loans secured by cash collateral and marketable securities. Non-deposit account services means things like non-deposit investment products and insurance. Your credit union almost certainly offers at least some of these products and services, such as wire transfers, ACH transactions, sales of monetary instruments, and electronic banking services, including ATMs and online banking. So, if you thought you didn't offer anything higher risk, think again. Next, higher risk persons and entities you serve. Although any type of account is potentially vulnerable to money laundering or terrorist financing, by the nature of their business, occupation, or the amount of transaction activity that can be expected, certain members, both individuals and groups, may pose specific risks. Do not automatically treat all members of these categories as posing the same levels of risks, though. You have to consider other variables too. The FFIEC's list includes those categories on the slide, and let me point out a few in particular. Foreign financial institutions includes banks and foreign money service providers like currency exchanges and money transmitters, and what are called casas de cambio. Non-bank financial institutions includes casinos, brokers or dealers in securities, and dealers in precious metals, stones, or jewels. Your local jewelry store, then, is potentially a higher risk customer. You can identify whether a credit union serves non-resident aliens by obtaining a list of members or account holders who filed IRS W-8 forms. Cash-intensive businesses includes things like convenience stores, restaurants, retail stores, liquor stores, privately owned ATMs, vending machine operators, and parking garages. Professional service providers, that includes attorneys, accountants, doctors, and real estate brokers. Again, most credit unions have at least some members who fall into one of these categories, so don't automatically assume that you only serve low-risk members. Serving certain geographic areas may also pose higher risks of money laundering. The FFIEC manual lists a variety of international locations, including any countries that are subject to OFAC sanctions, which we cover in Part 3 of this webinar series. You also have to see whether your credit union has offices in or serves members in certain U.S. areas that the federal government designates as high risk. These include high-intensity financial crime areas, or HIFCAs. There are none in Wisconsin, but several counties in the Chicago metro area are HIFCAs. Other parts of the country are designated as high-intensity drug trafficking areas, or HIDTAs. In Wisconsin, these counties include Brown, Dane, Kenosha, Milwaukee, Racine, Rock, and Waukesha. If your credit union operates in those counties or has members living in them, you potentially have higher risks. After you have identified the risk categories that apply to your credit union, step 2 is to conduct a more detailed analysis to better assess the credit union's risk exposure within the identified risk categories. Do some data mining to understand the volume of each activity and evaluate whether existing controls help mitigate risks. Step 3 is to adjust the credit union's BSA AML program to address the credit union's specific risk profile. Your customer identification, customer due diligence, suspicious activity monitoring, and OFAC practices should all be risk-based, with particular attention focused on high-risk products, high-risk customers, and high-risk geographic locations. Let's say, for example, that you allow members to join the credit union and open accounts by mail. That's obviously a higher risk practice, so your BSA procedures should specifically address what extra steps you'll take in those situations to help mitigate BSA risks. Step 4. Once you have a written program in place, you need to keep it up to date, and that requires an up-to-date risk assessment. The regulators say that you should update the risk assessment at least every 12 to 18 months. You may need to do it more often if key elements in your credit union's risk profile change. Management's evaluation of the risks of money laundering and terrorist financing should evolve as, for example, new products and services are introduced, or existing products and services change, or the credit union expands through mergers and acquisitions, credit union initiatives, or even hiring new sales personnel, since some like to bring over their clients from their former employer. The cornerstone of it all is the credit union's BSA policy. It must be based on the credit union's risk assessment. The NCOA says that at a minimum, a credit union's BSA compliance program must be written, approved by the board of directors, and noted in the board's meeting minutes. So it's the responsibility of the board to see to it that the credit union has an effective BSA policy and program in place. A model BSA policy is available to league members via Policy Aid. They offer a comprehensive online compliance policy library, giving credit unions access to more than 100 sample policies that you can download and adapt to fit your needs. This is a dues-supported service that the league contracts for on behalf of all our member credit unions. Let me emphasize that you should not simply adopt any sample policy as is. You need to consider your credit union's unique needs, resources, and risks, and then tailor the policy to the credit union's processes. So, what exactly does your policy need to address? The NCOA rules say that it must address at least 5 fundamental items. Examiners refer to these as the 5 pillars of BSA compliance. Those 5 BSA pillars are on the slide. They are, number 1, training for employees and the board. Number 2, daily coordination and monitoring of compliance by a designated person, in other words, a BSA compliance officer. Number 3, independent testing of BSA compliance. Number 4, a system of internal controls to ensure ongoing compliance. And number 5, a customer due diligence program. Let me talk a bit about each of these 5 requirements. The first requirement is training. Credit union personnel must be trained on all BSA requirements and understand the credit union's internal policies and procedures. This means that simply watching this webinar series is not enough. Credit union staff also needs to be trained on the credit union's internal procedures for BSA compliance. An effective training program includes 3 things. First, training is needed for all credit union personnel who have contact with members and handle currency. Tellers, member service representatives, loan officers, and so on are included. The NCOA says that training should be done at least annually, and it should include current developments like new money laundering schemes. The training should not just cover the BSA legal requirements that I'm discussing right now. It should also cover the credit union's internal processes, so that staff knows exactly what's expected of them to help the credit union stay in compliance. Second, new employees need to be trained on BSA requirements and internal procedures. And third, your executives and board of directors must be kept up to date. The training for the board doesn't need to be as in-depth as for employees, but the board has to know about the basics of BSA to ensure that the credit union has an adequate program in place. The second requirement or pillar is that the board needs to designate a BSA compliance officer. That person has day-to-day responsibility for the credit union's BSA program. The board should also designate a backup BSA compliance officer to oversee the program if the main compliance officer is unavailable or leaves the credit union. The BSA compliance officer has to be knowledgeable about BSA, but the person also needs to have a good understanding of the credit union's products, services, field of membership, and geographic locations, so that he or she knows the potential money laundering and terrorist financing risks that the credit union may face. The officer needs the expertise to know what's required and should have the authority, time, and resources to get the job done. It's the responsibility of the board and management to see to it that the BSA compliance officer has the tools he or she needs. The third fundamental requirement for BSA compliance is that your program has to be independently tested. That testing should be done every 12 to 18 months, depending on the credit union's risk level. Audit findings should be incorporated into a report for senior management and the board. And management must follow up on any issues and recommendations that come out of that BSA review. Any qualified person, such as an outside auditor, internal staff, or volunteer official, can perform the testing, as long as the person understands BSA compliance and is independent of the credit union's BSA program. The independence requirement means that the BSA officer cannot do the testing, since he or she is involved in the BSA program that's being tested. The League offers independent testing for BSA compliance as part of our Compliance Specialist program. Please contact the League if you'd like more information on how we can help you comply with this requirement. The fourth fundamental BSA requirement is the most complicated. Your BSA program must include a system of internal controls. That term refers to the credit union's policies and procedures to limit and control risk and to achieve compliance with the BSA. The level of sophistication of those internal controls should match the size, structure, risks, and complexity of the credit union's operations. For example, to help fight money laundering, credit unions need procedures and processes to spot two kinds of reportable transactions: currency transactions of more than $10,000 in a day, and transactions that are suspicious. These need to be reported to authorities, and we go into detail about that requirement in Part 2 of this webinar series. Certain other types of transactions don't have to be reported, but the credit union needs to record information about them in case investigators ask in the future. These include sales of money orders or cashier's checks and wire transfer information. We'll look at those rules in Part 3 of this series. The credit union should also have procedures in place to make sure the reports are done accurately, to make sure that employees are adequately supervised, and there should be a system of dual controls in place, meaning that employees who complete the forms aren't responsible for filing them or for performing the annual compliance testing. The fifth pillar is customer due diligence. FinCEN's BSA regulations require credit unions and other covered institutions, including banks, to have written, risk-based procedures for conducting customer due diligence, or CDD, as part of their BSA programs. Compliance was mandatory in early 2018. Before then, FinCEN did not explicitly require CDD, although regulators and examiners expected it and said it was implicitly required by BSA's suspicious activity reporting obligations. There are two aspects to FinCEN's CDD requirements. First, CDD requires risk-based procedures to help the credit union understand the nature and purpose of its member relationships, so that the credit union can develop a member risk profile and monitor for suspicious activity. The point here is that regulators want credit unions to develop an understanding of what a member's normal and expected account activity will be. And that way, the credit union knows when something unusual is happening, and it can more effectively report suspicious activity. Also, they want credit unions to be able to allocate their resources efficiently. So each credit union needs to identify members that it considers higher risk. Then compliance staff can devote time to monitoring their accounts more closely for suspicious activity, which the regulators call enhanced due diligence. Second, the CDD rules require credit unions to identify and then to verify the identities of the quote-unquote beneficial owners of legal entity customers, which means most businesses that the credit union serves. We go into details of CDD in Part 2 of this webinar series. If you have questions on BSA, OFAC, or any other compliance issues, please let us know. One of the benefits of League membership is that your credit union's staff, management, and volunteers can contact the Legal Affairs Department anytime for compliance information. You can call the League's 800 number and speak with any of the attorneys in the Legal Affairs Department, or you can email us, and one of us will reply usually the same day. Reach out as often as needed. There's no limit on the number of compliance questions we'll help any of our credit unions answer.